Now, property.
Yeah.
Always something to talk about in that sector. Australia's capital city CBDs, well, they're coming back to life. We only have to sort of walk outside and we can
It was so
see
busy
that.
today.
Sentiment in commercial property markets floundered though across Australia in the third quarter. Here to take a look at what's happening in that sector is Anthony Landahl from Equilibria Finance. Anthony, good to see you. The fact that you're actually joining us in the studio is testament to what's going on right now out there, that things are moving again. Are they moving though in the commercial property sector?
Yeah, nice to be back in the studio. NAB's market sentiment report for Q3 indicated that sentiment is down to a 12-month low, particularly in retail, hotel space, and also in hospitality and office space. So that is a concern in the market. And what I think NAB are picking up on is it's moving from just being a sentiment to something that's getting built into the market now in office space commercially. On the flip side, industrial space, mainly driven on the back of warehousing and logistic needs and online demand, the sentiment was up 64 points. But in retail, it was down about 17 points, office space similar, and in CBD hotels, it was down about 64 points on the last 12 months. The fear being that that's going to start running into rents and potentially then into asset values.
Yes, the infrastructural changes going forward, long-term effects from the COVID pandemic, what are they likely to be when it comes to this sector? Yeah,
well, longer term, we're seeing a shift in what tenants want. We're seeing a shift in what corporates are looking at for their staff. We're seeing a shift in what staff expectation are. So we're actually seeing a shift towards smaller space that might have some of the comforts of working from home, funnily enough, and space people might only come into for 2 or 3 days a week. So there's a real shift in what companies are looking for, but that's also giving tenants some pretty good leverage when they're trying to get in the market into the cities. We're sitting in the studio today, but I saw an interesting statistic recently that Sydney and Melbourne's foot traffic is 30% of what it was pre-pandemic. So the concern is, are people actually coming back into the cities?
Yeah, and I guess there's some thought perhaps that, well, people are simply going to wait till after Christmas, the new year, and then come back. Or perhaps if there's something more permanent about this, there is structural change.
Yeah, I think people are starting to now build in that there might be some structural change in how people are working and what the expectation is around the needs of the tenants in the city.
And of course, we had RBA this week. Are people starting to get nervous that those rates might start to hike?
I think they're starting to be built in, is what we're seeing. I think there's a little bit of uncertainty in the market at the moment with the RBA essentially, while they held rates, they did indicate that their longer term projection of the 2024 holding it at the 10 basis points has essentially now been gone out the window, for want of a better phrase, and they're essentially looking at bringing that forward with inflation rising a little bit faster than they expected, unemployment coming back to the levels they're looking for. So I think we're starting to see it being built into the fixed rates. All of the majors have now shuffled their 3, 4, 5 year fixed rates. The others are starting to follow. Variable rates are still very competitive, but I think that is starting to be built in, that we're looking at maybe a shift in, maybe a percentage shift around end of 2022, then 23 instead of 2024.
Have you noticed a change in loan approvals at all, particularly, I guess, now that APRA buffer rate has taken effect? It remains to be seen whether more is coming. But I guess when you break this down between owner-occupiers and investors, have you noticed a change?
It'll start flowing through now. The providers have now, they essentially had a grace period till 31 October. We're a couple of days past that. So all of the providers have now adjusted their servicing ratios. And when we're doing the analysis, it has about a 5% impact. The main people we're seeing impacted are probably highly leveraged investors and those looking at really maximising their borrowing potential from an owner-occupier perspective. Often for a first home buyer, the challenge is actually the deposit. So probably one of the main impacts is across highly leveraged investors trying to borrow to their maximum capacity again. I think overall it'll have a fairly modest effect on the market, to be frank. But yeah, people are starting to factor it in and people are starting to, I guess, adjust their expectations a little bit.
And overall, what effect is this having on the market? Because we're sort of seeing different projections here that we'll see further growth next year, but the heat has come off somewhat, particularly as supply has increased at the same time.
Yeah, that's right, Andrew. Supply this time of year usually increases about 16%, and this year real estate agents reckon there was about another 10% of properties being sandbagged, which we are now seeing to come onto the market, and demand hasn't met that. So we are seeing an increase in supply, which is good for the market. So the rate of growth was, while it was still about 1.5% to 2% nationally in October, the rate of growth is slowing down as supply comes onto the market, as the APRA changes flow through, and there's some adjustment in interest rates. So it'll be interesting to see how that settles in the new year, but at this stage we are seeing a slowing in that rate of growth.
Anthony, good one. Thanks for joining us from Equilibria Finance.
No worries at all.
Thanks
See you
so
later.
much, Anthony.